Hey guys, hello and welcome to another episode of the Strategy Lab videos. My name is Alexander Nikitin. I'm a professional trader and a developer of pattern search software. So if you guys are new, what I do in these videos, I actually explain the details, the tips, the secrets, maybe some intricacies of advanced pattern trading and harmonic pattern trading. So if you are a fan of these strategies, then you came to the right place. Okay, today I will share you the footage from my live trading webinar that I hosted on Friday, last Friday. Unfortunately, not many of you could attend, after that I had very many requests for the recording, and I didn't record the webinar. That's why now I'm recording the video to touch upon some topics that were discussed in the webinar. Well, but before I do that, I am first to show you my new ideas that I have right now, and it will make the further material to be understood better. Okay, so what I did recently, I have created the classification of currencies, and I classified them according to the three categories. The first category is called risky. And here, what currencies we have here? We have Euro, we have GBP, maybe Swissy, whatever. It doesn't matter, let's say only within the major pairs, yes? Euro and GBP. Next, what we have next? The next category of currencies, I call them shelter category. They are USD, they are JPY, and so on and so forth. They are shelter categories. Okay, and the third category of currencies is called commodity currencies. Commodity currencies. And they are AUD, they are NZD, and they are Canadian, for example. So the major pairs are listed here. Of course, here we can have Singaporean dollar, we can have Swissy, we can have other minor currencies. But to keep things simple, let's just stay within the major pairs circle. Okay, what I mean now. Let's combine these currencies and compile some pairs. So what if we talk about euro dollar, what will be this pair? This is actually the base currency that belongs to risky and the quoted currency that belongs to shelter. So that's why we have a class of pairs that are called risky shelter pairs. Risky shelter pairs. Okay, and what are these pairs? They are Euro, USD, they are Euro, JPY, they are GBP, USD, they are GBP, JPY, and so on and so forth. You can enlarge the list to infinity. Okay, now this is the list of risky shelter pairs. Okay, now let's do the next class of pairs is the risky commodity pairs, and they are Euro Aussie, they are GBP Canadian, they are models Euro NZD. It doesn't matter, you can compile the list to your taste. Risky shelter pairs. Okay, the next is this commodity shelter. Commodity shelter. And they are Australian dollar. Yes, they are New Zealand. USD, they are USD Canadian. It is inversed, but it is still within this class. When these two move to the upside, this moves to the downside, negative correlation, but it is strong correlation. And class number 4 is the one that stands outside of this tree, and I call it same sector classes. So if we take the sector of risky currencies and we take the same pairs from the same sector, Euro GBP will be the same sector currency. And let me type it this way: SS pairs. Pairs from the same sector, currencies from the same sector. The pairs are this: Euro GBP, they are USD JPY, because they both belong to Shelter, they are AUD Canadian, and so on and so forth. Okay, hope you understood the main idea. So I have 4 classes of pairs based on 3 sectors of currencies. Yes, the 4 classes based on 3 sectors. And what I noticed while doing my backtesting of advanced patterns and harmonic patterns is that they are not the same. They have something in common within this class, but the classes are very different. I did a profound research on risky shelter and commodity shelter, and I started my research on risky commodity. It's not not risky commodity, and to same class pairs, same sector pairs. Yes, started my research on that, and risky commodity is left. Once I will finish that, of course, I will update you about that information. So what I found for now, the risky shelter, what is the personality of that pair? Typically it moves this way. I will talk about 1 hour time frame. It is my trading time frame. I didn't do the research of 4 hour, of daily, of whatever. I don't care about that, but if you'd like, you are welcome to do that according to that classification, and then simply leave me a message with your results. So what is the typical movement of 1 hour time frame on euro dollar, euro yen, pound dollar, pound yen on risky shelter pairs? It is this. We have swing high to swing low, this to this. Prominent swings and very clear picture, something like this. So if we talk about the cipher pattern, yes, I was talking about cipher pattern on Friday, and I taught the rules of identification, trade execution, and trade management of this pattern. If we talk about the cipher pattern, then large swing identification algorithm, that's these swings, is the one that is applicable for that, and smaller algorithms are not applicable to that. Smaller algorithms will lose. So if you will try to trade ciphers within this small correction area, you will most likely be blown up. So you have to trade according to the major movement, major swing, large swing identification. Okay, hope you understood that. I will show you in a graph what I mean. It is deleted, unfortunately. Now it is back. Yes. Okay, let me delete this stuff, if it can be deleted. And now let me draw the typical picture for commodity shelter pairs. They typically look this way. We first have kind of movement straight to the upside, and then we have this sideways. Then we have a movement, then we have this sideways. Then we have the downside, then we have it sideways, downside, something like this. So if you would try to trade your patterns here according to these large swings, yes, you will most likely fail. But what you can do, you can trade small patterns, minor patterns within these consolidation areas. So they are vice versa. They are inverse to that risk shelter pairs. Risk shelter pairs are better with large swing identification algorithm, and commodity shelter are better with smaller swing identification algorithm. And it's very important because many pattern traders, in quotes, start from the wrong end. Before you know how to identify swings, before you know you learn before you create your own rules that will tell you mathematically that this is a swing low and this is a swing high. Before you know this, you go to learn the patterns, you go to measure the ratios between those swings. What are you measuring then? If you don't know what is the swing low and what is the swing high movement, what are you measuring? 50%, this means a bad pattern, 618 means a godly pattern. 618 of what? 50% of what? Answer this question. Okay, so what I did it very simple. I have created 5 swing identification algorithms. 4 of them are automatic, 1 of them is manual for my personal needs first, and I did the profound market research that I found that not pairs are the same. Every pair has its own personality, and then I was developing my idea further and further and further, and then I came up to this classification that the personality of pair belongs to the class that this pair belongs to. And to show you what I mean is this. For example, if we go to the chart, yes, and let me go to my Monster Pattern Search Pro. This is the software that I have created. To do the backtest on history, you simply need to type -1 and do some other tweaks if you wish, and switch the algorithm from manual to, let's say, large. You see that? And the patterns are drawn automatically. So how these patterns are drawn? This point is taken from the chart, point number 1. This point is taken from the chart, point number 2. This point is taken from the chart, point number 3, and this point is taken from the chart, point number 4. So these 4 points are taken from the chart according to the large swing identification algorithm that tells them what exactly these points are. And point number 5, which is a completion point, is calculated based on these 4 previous points. So you see 4 points coincide. 5th point does not coincide. It should go to reversal, to some reversal area, but it is not. It is a prediction. Price may never go there, as in this situation, and price came here and reversed, giving us targets like this. Let me zoom it up slightly. It reversed, the level reached. This was the predicted level. Slightly double bottom or whatever, and boom, trade to target. You see that? This is the difference between my software and some other software that takes the point number 5 from the chart. It is already late when you have a reversal. It is already late to enter. So it is impossible to take the point number 5 from the chart. It can only be calculated and predicted in advance. Only in this manner you can trade the patterns. Otherwise you will be cheating. You will be working good on history because historical points are already done, and you will be absolutely losing real-time trading because your patterns will be constantly redrawn as price action goes further and further and further and never reverse. You change your 5th points will change and change and change like this. Never completed. Never completed. So the software doesn't know if the pattern will be completed or not. Okay, but here it completed and went to target. It completed, went to target. Here, this small, when I say small, the algorithm is large, but the pattern may be small. You should not mix that terminology. It is a loss. This is a winner. Absolutely objective. Losers, winners, not only winners, not only reversals, but absolutely objective. Okay, once you understood how the research work was done, and once you understood that it was absolutely objective, now let's go to my results. And I have compiled them into Excel spreadsheet, and here what I was talking about, the Euro-Dollar large swing identification algorithm. It's not necessarily large patterns, but swing identification algorithm is large. I won't reveal you the secrets how I do calculate my swings. It is my secret. But what we have 71% winners, 0.69. This is only 1 hour time frame. You see how many trades we have? Let's see, 133. 133 trades. The period from 1999 towards 2017, so it is 18-year period. Okay, the win percentage 71%. Darren Oglesby said the cipher pattern is 86%. Well, objective calculation says it is not. And I know because Darren Oglesby probably did his research work manually, and we tend to find more winners when we do the backtesting. Objective research says that it is slightly less than 86%. Okay, then the risk to reward, average risk to reward 0.69, yes, and the expectancy. This is the most important thing, the expectancy. If this stays positive, that means the equity curve is rising over time. And regardless of how large is this number or how small is this number, as long as it's positive and you can consistently continue executing the same strategy, this stays, this generates money for you. Okay, but if we switch to medium, the same pattern, the cipher pattern, but the size is medium, you see the expectancy is negative. The win percentage stays 61, the average win is 0.64, and it is not even moving sideways, it is below zero. You see the difference? It is like to go shopping. When you go shopping, you want to buy a t-shirt, yes, and you check one, put it on, and it is large for you, yes. You take it off, then you put some with minor size, smaller size, until it fits you perfectly, something like that. So although the t-shirt is the same, but the size of the shirt is the smaller or larger, you have to do the backtest of that and find which one fits the pair perfectly. And if we go to my another Excel spreadsheet, the large cipher 1 hour multiply 1 and blah blah blah. Okay, here it is, and you will find it here: euro dollar, pound yen, and euro dollar, euro yen, pound dollar, pound yen. Look at this accuracy. Look at the accuracy. It is a reversal ciphers only. Euro dollar, euro yen, 67, 67. Pound dollar, you see 73. Pound yen, 73. So it is almost the same numbers. Well, I was backtesting reversal ciphers in my previous Excel spreadsheet. Here I'm talking about all the patterns, regardless of that being reversal or not reversal. Okay, medium, euro-dollar medium swing identification algorithm. How many of them we have? 177 trades. Of course, medium swing identification algorithm, it presupposes that we have a larger number of setups because they are smaller. Okay, but on euro-dollar, larger patterns work better, smaller patterns work worse, and this only highly depends on your swing identification. Let's go to Aussie dollar, larger patterns, larger swing identification algorithm. Boom, straight to hell, a waterfall, negative expectancy. So using this same technique of swing identification, this same pattern that was 71% accurate on euro dollar, absolutely no working on Aussie dollar. Under the same circumstances, you find losers only, 49% of winning. But if you switch the algorithm to medium, it fits the pair much better. You have 65% accuracy, you have positive expectancy, you have your average win of 0.66. You see? See the difference? Aussie dollar large, Aussie dollar medium. But euro dollar medium, Aussie dollar medium. See it? Okay, and I did the dollar yen large for now. This is what I was talking about, the same pair of dollar yen. Yes, I just started, so I did the dollar yen. Now I didn't do the dollar yen medium to compare what changes we have within this asset class. Okay, so what I want to do right now, I want to compile them all together to have the overall spreadsheet of overall performance of the patterns, regardless of them being large and being small or whatever. I have noticed one simple repetition within these patterns over and over again. It repeats the same, and now I will do the research, and you will witness that. So I have 692 patterns total. 692 patterns totals. So euro dollar large patterns, euro dollar medium patterns, Aussie dollar large patterns, Aussie dollar medium patterns, and dollar yen large patterns. 692, almost 700 patterns. Pretty good. I wish I had 300 more to have 1,000, but that's okay. That's okay. 700 pairs. Okay, what I'm talking about, I've done this risk to reward research work, and let me draw it first. Let us do the research of the cipher pattern, and the major structure of a cipher looks this way, yes? Like this to this. This is the price. And what it means, the research of risk to reward. Let's calculate the entry. Our entry is this. The entry is 786 and stop loss is 113. And let me make them white. Okay, so we know that they are this. And let me make this. Okay, use one color. Levels, lines. Okay, let it be. This way. Perfect. So now they became a bit more thick. What it means, the risk to reward? This is the target. And let me go to switch that into targets. I will not take the 618, I will only take the 382 simply to demonstrate you what I meant, for the purpose of demonstration. Okay, so what we have here, this is our entry. Yes, regardless of what, the entry stays the same. This is our stop loss. Regardless of what, the stop loss stays the same. So this distance never changes. It stays the same. But what happens when price exceeds the entry and doesn't reverse at 786? We have to restretch our Fibonacci's, you see, to fit the price action from lowest low to highest high. And this leads to this phenomena that the target, you see, the target goes higher. And if the target goes higher, our risk to reward changes. Let me demonstrate it this way. Here's the position calculator. Here's. This is the what? Stop loss. And this is the take profit. So it shows 0.767 risk to reward, yes? But initially it was 0.87. 0.87. So if price travels all the way to the upside to almost to stop loss and reverses somewhere here, yes, somewhere at this point it reverses, then you will only have this target, and 0.29 will be your target. Hope you understood that. The higher is the reversal point, the smaller is your risk to reward. And I found the correlation. So if I know where is my reversal point, I can calculate my risk to reward, and vice versa. If I know my risk to reward, I can calculate my reversal point. You see that? And if you pay attention here, I have columns. They are called chart stop loss and chart take profit. So judging by them, I can calculate my risk to reward, divide the chart take profit by chart stop loss, yes, from the chart. And I created two of them. They will be modified. Right now they equal to the chart stop loss, you see, 651 to 651. They're equal, but we will modify them slightly later. Okay, continue. I just told you that if I know my risk to reward, I can calculate the exact point where the reversal took place. So what I want to calculate, I want to calculate the frequency of how often price reverses at, let's say, 886 rather than 786. How often price does this? Maybe it is better to trade ciphers starting from 886. How often price exceeds 786? How often price goes past X? How often price reverses, let's say, at 113 or 1.10? You see? Do you want to answer these questions? Yes, I want. I will answer these questions. And let me copy that, go to master spreadsheet, let me paste them here. And I don't need formula, I only will paste values of them. Okay, now let's calculate the frequency. And to calculate the frequency, you first need to understand some statistics. Oh, come on, Control Z. To understand the statistics things and you need to understand some statistical formula. I will try to make it as simple as possible. So the first cell will be called frequency. Frequency. You see that? Okay, perfect. Okay, and the next cell will be having that formula. It equals count ifs, and within this range where I have my risk to reward, yes, I need the first criteria. The first criteria that it should be less or equals to. Sorry, less or equals to. I know that I never have a risk reward greater than 2, that let it be less or equals to, just an extreme size. And my second criteria should be this. It should be more or equals to what? More or equals to this cell, to my first risk reward value. You see that? So the first calculates it this way. What if you have it more than this risk to reward? And it is actually answers the questions how many trades we have that reversed exactly at 786. Out of 430 trades that totally reversed, 430 trades winners, they reversed. This 261 never reversed, they passed through towards the stop loss. Yes? And 430 trades reversed. So out of these 430 trades, 22 have this thing. And let's calculate the percentage, of course. So this equals 22 divided this cell, the winners. Yes, so we know what is the percentage of reversals. Percent and percent. Okay, perfect. Well, let me make it this way, 5%. 5.12% of all the reversal took place exactly at 786. Well, this percentage is pretty large. Do you see that? It is enormous, pretty large percentage. 5% of all trades reversed exactly at 786, not 787, but at 786 sharp. Okay. And now I just copied this formula here, but I will adjust it. But right now, here in the first criteria, it should be not less than 2. Yes, it should be not less than that our extreme, but it should be less than our previous range. So the next criteria will calculate what, how many trades reversed at 787. Or between the range of 786 to 787 if we have some decimals, hundreds of thousands of decimals. So what, how many trades we have reversed at 786 to 787. You see that? So the formula will be telling this. We only have 3 trades that reversed there. And if I restretch this, it is 0.70%. You see? And if I stretch it, it will automatically substitute all this empty blank cells, and it will tell me what was the reversal. 0.23 of all trades reversed at 1.12. You see that? Now I have the percentage. And what I want to do, I am to make a frequency chart. I am to do a frequency chart to create that. Let me do it this way. I will first go and choose them all and go to insert the line here. Oh, no, I don't want the line. Change chart type, columns. Perfect. So, and let me move it somewhere to a new sheet. Okay, here's the frequency. And what you notice here, let's analyze that. This is the frequency of distribution of those reversals. The majority of them took place at 786. And then we have slightly decreasing, yes, and then we again have some spike, and then again slightly decreasing. And also you should see how many of trades we have here. We have very close to each other, and here they become very far from one another. Yes, the distance between these occurrences is different, and it all starts somewhere at this midpoint. So what I'm referring to is that the distance between them, you can see it is wide, and here it is very small distance between the trades. They are closer to each other, and here they are wider. What if I don't trade this? Maybe they are accidental trades, and these, the majority of trades, the majority of reversals are those that are true reversals, that are valid reversals. Yes. Okay, so first of all I should know what is the reversal. Right now it calculates as 1, 2, 3, 4, 5, 6, 7. It's not okay for me, and let me go to select data, and I will go to this chart and I will edit this axis range, and the axis range should be from the reversal. Yes, perfect. Thinking a bit, come on. Okay, and now it shows me what? It shows me this. You see, now it shows me the numbers 786 and blah 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 blah. So I made a decision that somewhere here, yes, I made a decision that somewhere here, from here to here, makes no sense of trading. Yes, and if I pay attention to that, you see what is number here? It is the number 1. So the majority of reversals took place before 1, and the other patterns after 1. They are looking kind of accidental. They are not that very much close to each other. And what is my idea? What's my idea here is that what if I do not put my stop loss at 113? Yes. What if I put my stop loss at exactly 1? Because the majority of trades reverse before 1, and it will lead to this. My risk to reward will decrease. My most unfavorable risk to reward will be that 0.8, and my most favorable will be, I don't know, 1.5, 1.6, 1.4. Yes, you see that my risk reward will increase. Okay, and my question is this: do I really need to risk this additional difference from 1 to 113? If these trades that reverse exactly at this area will recover all my losses that I have with this additional risk, yes, I have losses because my stop loss is sometimes wider, yes, 0.6, 2/3 wider. It looks like 2/3. This stop loss is 2/3 of the whole stop loss. At least it looks like that. What if I will risk less? If I will risk less, my losses will become less and my winners become more. yes, relatively. And this means that will I generate more money if I will risk less? Of course, I know that these trades that reverse here, they will be turned into losses because they are stop loss at 1. Yes, they will be turned into losses, and I will have less accuracy, maybe slightly above 50. I don't know yet, but maybe slightly above 50. But does it worth that? Does it worth placing the stop loss exactly at X? Let us check. Numbers will tell. And to do that, first of all, let me make this graph as well. Okay, this is the graph. Insert and let it look this way. This is the percentage graph, and it shows the percentage. And you see what are the percentages. If you are interested. Okay, so continue our research, and let me show you something. Okay, the expectancy. Let me first record the data. Expectancy. The old expectancy equals to 0.0364. Okay, perfect. The old risk to win ratio, yes, win percentage equals to 0.6223. The win percentage equals this, 0.6223, and the average win equals to 0.66. Okay, so when I will change the data here, yes, when I will turn those trades into losers, and it will change here, it won't change here, but it will change recalculated here, and we then compare the old and the new. Okay, first of all, what we need to do, we know that these trades that reverse exactly at 1, they are what? The trades that reverse exactly at 1, these ones, yes, they have the risk to reward of 0.48. Okay, if the trade is having the risk to reward of 0.49, it means it didn't touch 1. But if it is more than 0.49, it means that it did touch. Okay. So 0.49, less than 0.49. And let's go to result, and it is very simple. You should go to filter, and you filter all those trades, number filters, that are between 0, because they should be winners, yes? You are filtering winners. And you filter them all that is less than 0.49. You have your risk to rewards calculated here. So 0.29 is less? Yes. 0.42 is less? Yes. They are all less than 0.49. And here we see the exit points, the exit pips. And they were actually the take profit pips. Yes, because priced finally it reversed. It reversed past X, but it did the reversal. But if we place our stop loss exactly at X, we will have a stop loss here. So what I'm to do, it equals minus stop loss. Okay, you can see it is a stop loss. Let me substitute that formula into every cell. Okay, perfect. Now they are stop losses. They equal minus 626 pips. So you see the chart stop loss says 626 pips is your stop loss. So minus 62.6. Perfect. Now it's not 600 because I have 5-digit bracket. By the way, it is 62.6. 62.6 here as well. Let's go next. Let us disable the filter. This way, yes? We disable. expectancy turned into negative, but it is not true. I will show you. The standard stop loss 113, stop loss distance, equals to what? It equals 113 minus 0.786, and it is okay. It equals 0.344. Agree? Yes, of course. And optimized stop loss, let me type it here. Optimized stop loss distance, if I place the stop loss at exactly 1, it equals 1 minus 0.786. Or once again, it equals. Perfect. So this is 0.21 and 4. And now let's calculate how these stop losses related to each other. Of course, I understand that 0.34 and 4 represents full stop loss. It is 100 stop loss, or this is the chart stop loss, the one that I have on my chart. And this optimized stop loss is some portion of that stop loss, because it is smaller than that. It is modified stop loss. So what is the portion? What is the relation between them? What are the proportions? The percent difference. It equals new stop loss divided old stop loss, and we have it this way: 0.62209302. And you see they are related to each other almost as the golden ratio of 618, 0.618, yes? And I think this is not accidental. And this is a golden mean ratio, is not accidental here. Okay, so what it means that our new stop loss is 0.62 of our old stop loss. Yes? Yes. Okay, and that's why we need this new and new stop loss and new take profit columns. Right now it equals to chart stop loss. Yes? But I want this stop loss be 0.62. So what I need to do, 0.62, what are other 209, something like this, 0.62, 209, 305, okay, it will be enough, 305, now it is tremendous precision, 0.62, 209, blah blah blah, of our full stop loss. This was the full stop loss, this is our new stop loss distance. Okay, and let me substitute that within all stop losses. Now all stop losses are less, they are 0.62 of initial stop loss. And look what happened. The average win turned into 1.15 instead of 0.66. Of course, the average loss decreased. Win percentage decreased. We had 62 win percentage, but now we have 51 win percentage. But look at the expectancy. The expectancy is very important. The expectancy turned from 0.3 into 0.10. It is 3 times larger, more than 3 times larger. For example, if you were generating, I don't know, 1,000 pips per month, let's say, then simply using this stop loss, you will generate 3,000 pips a month. So it is 3 times better. Although the accuracy is less, the risk to reward makes it work. Okay, hope you understood this as well. And that's it. I will also do the calculation of that for each and every situation for this specific stuffs. What if, will the results improve if I use this kind of stop loss with euro-dollar large swing identification algorithm? Will the results improve if I use them with the euro-dollar medium swing identification algorithm? Maybe it may not improve. Okay, yes. On on average it improves the results on average when we have all patterns regardless of the algorithms. Yes, on average it improves, but if going deeper into details, peer-to-peer basis, to fine-tune, maybe some pairs better traded with the old stop loss, and some pairs will be very much improved with larger stop loss or smaller stop loss. Okay, so these are the results. Once again, guys, 100 stop loss is working better, 100% rather than 113. So no need to risk that additional distance. And second, every pair has its own personality. And the same swing identification algorithm finding, let's say, large ciphers that work on 1 hour euro-dollar, it won't work on 1 hour Aussie dollar. So think about your swing identification algorithm, create your own rules of how exactly to identify swing low to swing high, and this way you will always have objective results, and you will know when to switch between the algorithm. Okay, well, and well, that's it, enough for today. If you want more, please subscribe, and I will share some more of my experience, and I will record more of those types of educational videos. Comment below and share this video on social media, and don't forget to click that thumbs up. I like when you hit that thumbs up button. Until then, good luck and good trading. Hope to see you soon.